In today's video, we're going to explain the 5 types of retirement plans with incredibly high failure rates. Every year, my company and I help retirees build retirement plans that achieve both their financial and retirement goals. The truth is, every retiree is different, but there are plans that can be incredibly dangerous for your retirement, which is why in this video, we'll break down the retirement plans you should avoid at all costs. Let's get into the video. So the number one plan is plans with aggressive withdrawal strategies, like the 4% rule, for example. The 4% rule suggests that when you hit retirement, you should withdraw 4% of your retirement balance. So for example, let's say your balance is $1 million. Well, you can withdraw $40,000 at retirement, and then what you do is you increase that $40,000 every year for inflation, and your money should last you for 30 years. There are several problems with this approach, however. First of all, many retirees can expect to live longer than 30 years in retirement, especially with advances in medicine. What this means is you could run out of funds early if you're relying on the 4% rule. Second, this rule was created in a completely different economic environment, and that means it doesn't account for today's historically low interest rates. So instead of using a fixed withdrawal rate, you should consider using a dynamic strategy that actually adjusts your withdrawals based on market performance and your personal spending needs. You could also use something like the bucket strategy to handle different time horizons for your assets, and it's going to give you a bit more flexibility to weather these market fluctuations. And if you're curious about those withdrawal strategies, be sure to hit subscribe because I've got another video where I take a deep dive into those types of flexible withdrawal strategies. Now, if you think the 4% rule might not work for you, you're probably right. But that's just the beginning. Next up, we have a common strategy that many people think is safe, but could actually lead to financial shortfalls, and that's number 2, plans that rely exclusively on target date funds. Target date funds are really popular investment options in most people's 401k retirement plans, and what they typically do is they start out with a certain mixture of stocks and bonds, and the younger you are and the further away you are from retirement, the more you have in stocks. And then as you approach retirement and through retirement, they gradually reduce the percentage that you own in stocks and they increase the percentage that you own in bonds. And effectively, they consider that a safer portfolio and something that's more appropriate for retirees. We could debate that topic all day. I'm not going to do that in this video. But the main problem with the target date fund approach is these funds are often overly conservative way too soon, and they're going to reduce your portfolio's potential for growth during a time when you need it. Beyond that, they simply don't account for your individual financial situation, which means they're probably not going to be a good fit for you and your personal goals. A much better approach is going to be building a more personalized investment strategy that balances growth and safety. Could be based on your risk tolerance, your financial goals, your income needs, rather than just taking a cookie cutter approach and throwing it in a target date fund and saying, forget it. Now, it's not just target date fund investing that is a potential pitfall. There are other types of plans where people sort of just set it and forget it, and you might be surprised by the risks lurking in the next strategy, and that is the set it and forget it plan. A lot of people, when they come into retirement, they will run a financial plan, which is great. I'm happy for you if you've done that. The problem is that retirement is dynamic. Changes in your health, market conditions, inflation, and tax laws are all going to significantly impact your retirement. If you fail to adjust your plan as you go forward, you could end up with less money than expected, meaning your funds might be depleted before your full retirement. Not a good outcome. I suggest people to review their retirement plan once a year. Maybe if there's really not a lot of changes going on, you don't have to do that every year, but probably at least every 3 years. That way you can make the necessary adjustments to changes in your life, the economy, your financial situation, whatever it is. And this is going to help ensure that your plan evolves as your needs change. So yeah, set it and forget it, not great. You need to constantly review. Now that leads us to our next plan, which is kind of sad, but a lot of people rely on this one too. And I'm going to tell you it's just simply not good enough. And that's the house as your retirement fund plan. This is the strategy where, hey, it's been a great market for homes, you've got a lot of equity in it, and you're not really saving hardly anything else on the side, and your strategy is, well, I'm just going to sell my home, downsize, and that's going to fund a significant portion of my retirement, probably in addition to Social Security. This is a terrible idea for a lot of reasons. I mean, number one, the housing market is unpredictable. You might not get as much as you expect from a sale. Number two, real estate is highly illiquid. If you are running low on cash and you need to sell your house in a pinch, it might not happen without you taking a significant discount to what the true value might be. And so you never want to be in that kind of situation. Plus, there's also this emotional challenge of selling your home. A lot of people get fixated on staying in their home, and so this is something you may run into, but then where are you going to get the cash to fund the rest of your retirement? As you can probably guess, people that rely only on Social Security aren't exactly in a good spot for retirement. You don't want to be one of them. So I would suggest treating your home as part of the diversified retirement strategy. You can consider downsizing it at some point, and that's fine. But the reality is, don't just only rely on your home equity for your retirement plan. You're going to have savings outside of your home if you really want a successful retirement. Now, I think we can all agree that relying on your house as your retirement plan is risky. But our last plan is one that might surprise you, but it's actually where I see a lot of retirees fall short, and that's number 5, plans that focus exclusively on accumulation, especially in retirement accounts. So a lot of people accumulate assets during their working years, especially in retirement accounts like 401ks and IRAs, but they're not planning for the distribution phase or anything else. And so, all else equal, yes, any savings you can get is great. The problem that I run into is if you focus solely on accumulation in a retirement account, you're going to be vulnerable to higher taxes and less flexibility when you need to make distributions. Beyond that, it ignores the other account types that are going to help you enhance your tax and withdrawal strategies in retirement. What I've seen many times is people think like, okay, man, I'm going to save $1 million in my 401k and then I'm out. But what they aren't considering is the fact that $1 million in a 401k, when you adjust for taxes, is actually maybe only $700,000 or $650,000, depending on where you live and your state taxes and so on. That $650,000, depending on your lifestyle needs, probably isn't going to be near as much as what you thought it was, as far as how much you're able to net from your withdrawals to cover your expenses. So I always encourage people, as early as they can start, to have a strategic plan for accumulating assets. And that's going to mean diversifying across asset types. That means saving in Roth IRAs if you're eligible, or maybe doing a backdoor Roth, saving in health savings accounts, and also taxable brokerage accounts, in addition to the tax-deferred accounts at work. When you have all of these coming into retirement, it's going to allow maximum flexibility for you to optimize your tax situation, optimize your withdrawals, strategic asset location, as well as getting the most income out of your portfolio. All right, now you know the 5 retirement plans you should avoid. So what's your next step? Well, if you want a strategy that actually works, tailored to your specific needs, click the link in the description to book a complimentary call with me. And don't forget to hit subscribe so you can learn more about retirement plans that hardly ever fail, and you can get more tips to make your retirement stress-free. Thanks for watching.